Good evening, everyone. On behalf of Indian Small Business and Franchise Association (ISFA), I would like to extend a warm welcome to all of you for joining us today at the insightful webinar on Road to IPO: Essential Strategies for MSMEs. We are delighted to have you with us as we dive deep into the essential strategy and best practices for SMEs looking to embark on the exciting journey towards an initial public offering IPO. The process of going public is a significant milestone for any business, and it comes with its unique challenges and opportunities. Understanding the crucial step, legalities, and strategic decisions involved can be a game changer for SMEs aiming to grow and expand. We are honored to have an esteemed panel of speakers with us today, bringing a wealth of experience in corporate law, financial services, and business development. Allow me to introduce them. Mr. Nitin Jain. Mr. Jain is a partner at Agama Law Associates with over 17 years of expertise in regulatory compliance, governance, and forensic investigation. He will moderate this panel discussion and highlighting key legal aspects and the current regulatory landscapes while guiding panelists to share their valuable insight on compliance and navigating the IPO process. Ms. Archana Balasubramanian, partner at Agama Law Associates with over 18 years of experience in corporate, commercial, and capital market and transaction law. She will provide insights into the legal framework for SMEs need to understand when preparing for an IPO. Mr. Ivor Misquit, Joint Managing Director and CEO of Indorent Financial Services Limited, will share his extensive knowledge as a merchant banker regarding the strategies, structuring, and financial planning required for a successful IPO launch. Mr. B. Ranganathan, corporate law advisor and trainer with 33 year of experience in governance in listed entities, company law, investment banking, and corporate restructuring. He will offer practical advice on positioning SMEs for an IPO, focusing on risk management and corporate governance. We would also like to extend a special thank to our knowledge partner, Agama Law Associate, for their invaluable contribution to this webinar. Their expertise and support have been instrumental in bringing this event to life. And we are truly grateful for their collaboration. Throughout today's session, our speakers will cover various aspects of the IPO journey, including legal considerations, regulatory challenges, financial planning, and strategic positioning. We encourage you to engage actively with the speakers, ask as many as questions, and take full advantage of this their expertise on this topic. And we will take all the questions at the end of the session, but during the session you can put your queries in FN Q&A box or either in a chat box. Once again, thank you all for being here, and we hope you find today's session informative, engaging, and inspiring as you take the next step on your road to IPO. Over to you, Nitinji.
Thank you very much, Akshat, and good evening, all the panelists, and thank you all the participants who have joined this session today. My idea and my role is going to be throw as many questions as possible to the panelists to get the maximum out for all the audience who have joined us today. So thank you, audience, for joining us. And with this, without wasting much time, moving to the first question to Mr. Ivor, who has seen industries from various lenses over the years, and now being part of the Indo-Orient, he has done dozens of SME IPOs from the initial era to the regime, which is getting tightening day by day. So Ivor, my question to you is, how do you perceive the SME IPO from the promoter's lenses, and why one should choose SME IPO?
Great, thanks a lot, Nitin. Pleasure to be here at this forum hosted by the Indian Small Business and Franchisee Association. And I truly appreciate this opportunity to present my views. What I would like to do is obviously present my views across four segments. Uh, One is, why should businesses look for an IPO? The next is, when should they look for an IPO? And when we talk about the when, I think what we'll also do is talk about what does it take to execute an IPO successfully. The third element would be, how do we begin? And the fourth would be looking at some of the constraints or concerns that come up in the minds of promoters when they think about this journey. Right? And I will touch upon some of these points at a very, very high level, not going into the details, so that I then the idea would be to trigger a question in the minds of the audience, and maybe we can deep dive into some of those statements either through the presentation that Archana or some of the updates that Archana and Mr. Ranganathan would provide, or in the Q&A, right? So when we say why, I mean, very interesting, because this is a question always comes up. We find all promoters who come to us say we want to raise capital. Yeah, everybody understands that you need money. Money has to be the primary driver to think about a public markets. Today you have banks who will not lend, or will lend only when you have collateral. There is a repayment obligation, there's an interest servicing obligation, and therefore it is but natural that promoters should start thinking about innovative ways of raising capital that they would need for growth and expansion. So raising money is absolutely one of the key requirements of looking at the IPO platform. But is it the only requirement, or is it the only consideration? The answer is no. Like I said, every business needs money, right? So raising capital and therefore thinking about the IPO platform should not be one of the key drivers. I think the IPO platform or the capital market ecosystem allows you to drive a lot more benefits, tangible and intangible, and therefore promoters should be very conscious of that. And when they are creating a strategy of going public, they should look at extrapolating some of those benefits and seeing how they can take advantage of that and what those benefits are. And I'm quoting some of these, based on what some of my clients have done, right? So we had one of the HR consulting companies go public in Jan. And the reason why they went public, because an HR consulting company obviously is, not like in dire needs of capital. They always are cash flow positive. They wanted branding. When they're starting to look at expansion overseas, they want to be known in the marketplace, right? So branding adds a very interesting element. The second is, how can you reduce cost? And sometimes in a lot of organizations, employee cost become a significant portion of their cost structure. Can you make employees equity partners, give them make them have a skin in the game? So your leadership team, your second in line, give them ESOPs, and those ESOPs only become valuable if you take your company public. So with an ESOP structure, you can probably reduce impact to PNL and compensate employees as and when the company does well, right? Tomorrow, when you want to expand, when you want to fuel the growth of the organizations through acquisitions or to additional capital raises, the capital market platform and the investors who engage with you from the inception of your journey on the platform will enable you to raise additional capital as and when required. So I think once a company successfully goes public, I think it is very rare that you'll find that the company will struggle to raise capital in different phases of its growth. So I think that kind of explains why you should look at the capital market. The second is when you should look at it. And like I said, I'm going to just introduce some of the key elements of a successful IPO. I was having a very interesting conversation last week with a promoter, and he said, "Look, I generally go to a bank and I don't need the money, because that's the time when I can sit and I can negotiate very well. I'm not pressed. I'm not pushed to the corner to do a deal at whatever rates of interest and reps and warranties." That is the same element and the same line of thinking that goes in when you raise any form of capital. So even if you want to think of a journey in the capital market, it is not about the capital that you need yesterday, but it's looking at the capital that you would need 6, 9, 12 months from now, right? So there should be a forward-looking approach. You shouldn't have a desperate need for money. If there is a desperate need for money, then maybe your timing of going public is wrong. Now, again, what does it take to do an IPO successfully, right? There are multiple elements. And again, this also dovetails into when you should do an IPO. So you should do an IPO when you have a strong story to sell. You exactly know why you're raising the money, where the money is going to be used, right? Your financial numbers, historical, have to be very strong. Most businesses operate on a taxation model. If that is the case, I would say think of an IPO journey at least with a 2-year horizon in mind, wherein you correct and course correct your books and records. Bring in profitability on the books because valuations are driven purely by profitability. Look at corporate governance. It's a very important and fundamental of executing a successful IPO. Investors not only look at you as a founder of the company or your team, they will also look at who do you have on your board of directors and all the other individuals associated with the company. That only increases the profile of the company. You have to look at legal entity structuring. Today, you have promoters who run multiple companies doing the same type of business. I think that's not a story that will sell in the markets. So you will have to consolidate and look at, how you can bring all related and complementary business under one umbrella and present a transaction that is really attractive to an investor. That also takes into consideration related party transactions, right? And how you can make sure that you successfully demonstrate that those related party transactions are in the best interest of the firm. Lastly, coming to, myths and concerns, right? So people come up and say, is it the right time? Am I too small? What is my risk? Will I lose control? Too much compliance? So again, look, if I go simply one by one, timing and am I too small? Let the experts decide. So you got Archana here, you got Mr. Ranganathan here. These are the individuals who will help you decide whether the timing is right for you to take a company public. Obviously, we will not like to take a company public if they're not ready or the timing is not right, right? So let the experts decide. What's the risk? When you say what's the risk, the question goes back to the founders to say, when you went and took loans from banks, did you ask the banker what's my risk? I don't think so. So I don't think that question is relevant. Loss of control. Look, Mukesh Ambani today, I think he owns not more than 40% of Reliance, yet he controls Reliance. There has been very little hostile takeovers in the Indian ecosystem. So loss of control should never really be a concern. Compliance, everything after GST, there is, irrespective of whether you're a listed entity, unlisted entity, the rigor is the same. I think that's, again, a non-starter. If you think every financial data point of a company is available in the public domain, so nothing is hidden from anybody in this ecosystem anymore. Time to complete, yes, it takes longer. I think the process is a little bit rigorous, but at the end of the day, once you complete the process, I think you will reap the fruits of unlocking value for your company. So I think that's the kind of pointers I wanted to highlight, Nitin. Happy to, see whether you had a follow-up or, move on to the next speaker.
Thank you
Thanks.
very much, Ivor. I think you have set the tone right with the very large question of why SME IPO. I think a lot of context has been set by you. So thank you very much for giving these insights. I am moving now to Mr. Ranganathan with your journey in the corporate world with over 3 decades. And now considering that you have seen the enough of security market, enough of regulatory regime, policy, advocacy, and you have seen large part from the governance perspective, from the main board of your experience, the SME who is a new game changer, we say in the Indian economy. What is your areas you would like to define for the SME IPOs, and in terms of what is the strategical and financial ways to look into from the SME IPOs perspective? Of course, by adding your value from the governance structure, Mr. Ranganathan.
Hi, good evening, everyone. Good evening, Nitin, and thanks to ISFA for inviting me to be a panelist on this. So from a main board to an SME IPO, in what way it differs, or rather, is there a great difference? But any entrepreneur, just in terms of his vision, I think his vision statement, instead of being as a normal English, I think he should live with up to his the vision statement. I think that is the first thing which as an entrepreneur should look for. Second thing is, whenever fundraising activity is being thought of by an entrepreneur, he is in the growth path. So that's where I think the timing of fundraising is something which is very important for every entrepreneur to look at. I think he has to look at a very phased manner of growth. That's the one thing which I would feel, which I have been seeing that a lot of companies, looking at others, they try to come and again get into the market, but that should not be the scenario. You should have your own vision, you should have your growth path, bring your story to the market, and live up to that. One of the big thing, I think Ivor and everybody, we all would be knowing that, first of all, define the business model very clearly. It should be understandable to a layman. I think that is where most of the, companies lack, and that's where, they should also take advantage, or they should take the help of a lot of good professionals around. That's one thing I would emphasize, that the business model should be a realistic. What was happening all these times, when all the SMEs were also on the, for other reasons, it was in the news. They were giving a very unrealistic picture about the real existence. I think why should, when I hit the market, I know I am being watched. I am being continuously watched. So why should I get into that mode? So first and foremost is you define the growth should be in a phased manner. Secondly, business model should be defined very clearly. This is one thing which I have observed in this past, 3-4 years, especially, even on the main board, sometimes, the regulator is very clear. If they don't understand the business model, they return the document, right? So it's the first thing that every businessman should understand. Second thing is, don't follow others. So create a positive picture in the minds of the investors, because you are looking at investors. You are not raising you're not going to a bank, as Ivor said, and taking a loan from, it's an equity, which is a permanent capital which lies, and you need investors, and you need good investors, of course. Good investors. That's why the latest amendments talks about, which talks about only, initially it was the maximum allottees were only restricted. I mean, the minimum allottees were 50. Now it's been increased to 200. That itself is a good sign. Though there have been a lot of, the number of shareholders are much more than that, but that's also a good sign. So it also depends on the quality of investors that you have. So that's the primary thing. And thirdly, being an entrepreneur, initially you would have started your business in the form of a proprietorship or a LLP or a partnership firm. That's fine. But when you get into the corporate world, when you get into the corporate mode or a corporate form of enterprise, that's the time where you should always think that, I have to go get into the corporate enterprise form in a few years' time. So let my business be modeled in such a way that it's easy for my, transition is very easy. I think that is also one of the things. So let the things, make the partnership firm very profitable at the initial stage itself, so that, your launching pad will be very smooth, That's the second the thing which, apart from the business model, the realistic picture that you should give. The third one is also start right from the beginning, looking at the things, because the intention of these regulations or this opening up of fundraising through the capital market to the SMEs is aimed not only at in the traditional, but also mostly focusing on innovations. So entrepreneurs, that's why a lot of startups which wants to come up, it is more into innovation thing. Then one more thing, then later on I will again take it up. Apart from this, don't forget the governance angle to it. Today, you should behave as if you are a listed company and start the process and have a good board composition. I think that is one of the things, yes, selecting a good director is also a Herculean task, but that's the reason I always emphasize, have some good professionals around you to guide from time to time is my take. Then we will come back on certain things, but this is what I would feel at this stage. This is what is required. Yeah. Over to you, Nitin.
Thank you very much, Mr. Ranganathan. Great inputs from the governance perspective. And what I liked the most was live up to your own vision. That is the statement. Many promoters who have joined this as an audience here, I am sure they will be thinking about these aspects on a daily basis. Live up to your own vision. And SME IPO is, I'm sure, is on the cards if they are looking for a futuristic perspective. Start right is absolutely important. First time right is the approach which everyone should and must take. Moving to Archana, Archana, you have seen now almost in 2 decades the M&As, the cross-border M&As to main board IPOs to now you are looking into the SME IPOs and handholding the promoters. The DRHP of 500 pages remains the same in the listing capital market while the due diligence on investor side is very different. But having said that, I have two questions for you, Archana, from your experience interacting with the stock exchanges, interacting with merchant bankers. How is the DRHP as a document, basically, in terms of preparing a due diligence, which becomes a part of the DRHP? How is this due diligence process different from the main board to the SME IPO for the stock exchanges, basically, who are dealing on the SME IPO side?
Sure, thanks for that, Nitin, and thanks everyone. Good evening. Happy to be a part of this wonderful panel. As a lawyer and as someone who writes documents, I think my perspective is very, very granular. So I'm going to try to make this as principle centered as possible, as macro as I can explain it to the audience at large. Essentially, what we are doing with the DRHP is once you have gone through this whole, why you want to do it, how much you want to get, etc., etc. It is very important to achieve a certain standard set by the regulator. The regulator tells you, puts kind of kind of a boundary on how much of your story you can tell. It also puts a kind of gives a very hard touchstone of benchmarking your own statements, backing it up by facts. And it's not just you as the promoter or not just you as the company who have to meet with those requirements, but it's also the other intermediaries in the system. So you will get a lot of questions from your merchant bankers, you will get a lot of questions from your lawyers. Why did you have this litigation? What is the impact of this contract? Why have you agreed to a minimum guarantee? So it is basically your story, but it is like a cross examination of the promoter of the business, and it is like a full it's like a full story but with the backup. Everything, every single statement in the DRHP needs to be backed up. So our the way we do diligence for M&A is very different from the way we approach a diligence for the IPO. In M&A, you're looking at how to save cost, you're looking at what should be the indemnities, you're looking at how to protect future downside and things like that. Whereas in IPO, you are answerable to the regulator. In the case of SMEs, you're answerable to the exchange first and ultimately SEBI. And B, you are answerable to your investors. So the big responsibility lies on the promoters, the board of directors firstly, and then the merchant bankers and the advisors to write that story correctly. SEBI has drawn contours. It tells you that you cannot use language which is likely to influence the outcome. You cannot use language which will mislead or not provide the entire facts. So our discovery when we do this, whether it is when we are looking at contracts, whether we are looking at litigation, whether we are looking at your permits and consents, that's the important part of your whole review and diligence part. If as a company you don't have necessary licenses to do your business, why will investors be interested in you? So these kind of things need to be answered. Apart from that, who are all the people in your close circle? Of course, a business needs their related parties to do business because it's easier, it is faster to do business with someone. There is more trust. But then, is that benchmark good enough when you are trying to take money from the public? So these are the kind of things that we need to answer through our diligence. What do we look at? We can only look at documents, what are provided by the company, but we also do a lot of public searches. It's not that I mean, there are enough and more public searches available today, which we do to correlate all this information.
Thank you so much, Archana. This perspective of the differentiation and what goes into the DD and ultimately in the DRHP. I have a one follow-on, very quick question for you. That once this whole outcome of the DD goes into the DRHP document, and once it is filed with the with the stock exchanges, my question to you is: in your experiences by filing these SME, IPO, DRHP documents, what is the common issues and common problem statements you have seen in terms of queries being raised from the stock exchanges?
So I think Nitin, maybe this question Ivar can also sort of pitch in. But from my perspective, what I've seen in my experience is that, especially with the exchanges, because the SMEs have to deal with exchanges, what we have seen is they come back with mostly diligence related questions, which is that you have said X, Y, or Z about your promoter, or you have said something about your business. Where is that coming in? Business modeling related. So, let's say you make a forecast or you have written something in your financials. These are the kind of things that typically the exchanges come back. And with the recent amendments, they have made the objects more stringent. So we can expect that if your objects of the issue are not fully vetted and finalized with your banker, these things are going to come back from the exchanges.
Understood. Thank you so much. It's a thorough
Yeah,
due diligence, which is the quintessential. So, Ivar, I'm coming to you with this continuation of this question from Archana, but I want also you to throw some light upon the key aspects of the valuations, the promoters' thinking and imagination of the valuations versus the reality of the valuation check. Because I always see the two ends never meet in terms of the expectation when the discussion is around the valuation. So with your dealing with
no, that's a
your
very tough
promoters
one. The
on real
valuation is
time
always a tough
basis,
question to answer. But just
yeah,
taking on from
over to you.
Archana's point, I think when you look at, say, how the regulator looks at the document, they look at risk factors. So, to see whether the risk factors documented are comprehensive. Today, exchanges are also looking in terms of the sequencing of risk factors. So they think that certain risk factors should be in the top 10 versus others, right? And Archana rightly pointed out, objects, again, a lot of substantiation needs to go into the object. So every line item as to every rupee being spent, you need to have an independent documentation around it. How do you justify the spend, right? And that becomes a very critical item of the whole exercise. Today, if you're raising money in excess of 100 crores, you have a monitoring agency as well, right? But nevertheless, even if it's less than 100 crores, yeah, the exchange has a right to demand that we put in place some monitoring agency. So I think, again, there is a lot of rigor going in from the exchanges today in terms of how the document is validated and vetted. Plus, I think you have to also understand is that, the exchanges also have other tools in terms of identifying, certain legal and litigation driven checks that they do. And it's quite possible that, when they do searches from PAN numbers and all of that, similar name individuals may crop up. So they come back and forth to check whether, is this the same person? Have they gone, do they have any litigation against their names, et cetera, right? So I think that those kind of form part of the common criteria or construct of questions that come in from the exchange. You mentioned about valuation. So the way we look at valuations as a banker, and I'll give you a perspective that I think every promoter should ideally look at it this way, right? The conversation with a banker should never start with valuation. The conversation with the banker should always start with saying that, look, here's my business. Here's what I want to do in the next 3 to 5 years. And here's the amount of money that I want to raise. Now, please help me understand whether can I raise the money through a capital market? And if not, what are the other ways of raising capital, right? So say you have a strategy of spending 100 crores, but your capital market only gives you 70. Does that mean that you dilute your strategy and only build a strategy around 70? I think not. I think that's short selling the potential of the company. And that's kind of also indicating to investors that, you're not ready to, you don't believe in the potential, or you don't see the opportunity. I think the strategy has to be built to 100, raise 70 via equity if that is what the bankers can commit, and raise the remaining via debt. But never dilute the strategy. That's point number one. When you look at the valuation, I think we look at valuation from an investor standpoint will play out across 5 pillars. What you've done historically. So what are your financial numbers like? Both profit and loss, balance sheet, cash flow statements. Right? Then again, what do you intend to do in the future? Right. So you say, yes, I want to, expand, I want to put up a greenfield project. What will that strategy entail in terms of top line and profitability growth? So you have to kind of be able to model the numbers for the next 3 to 5 years and demonstrate that yes, the money being spent will drive top line and profitability for the company. The third, and Mr. Ranganathan also highlighted on this one, corporate governance, right? Where is my leadership team? Who is my succession? Is there succession plan? Do I have a good board of directors, right? Who are the intermediaries that I work with? So all of these things amplifies the stability and the attractiveness of the business. I would point directions in terms of, if you look at EMA Partners India, the company that we took public in Jan, I think that board of directors would even be at par with some of the main board companies. So for a small board company to bring together a board of directors of that stature and credential speaks very highly of the intention of the promoters. The next is, yes, what is the opportunity? So you have to be able to explain the opportunity that you have, right? It's just not putting numbers on an Excel spreadsheet. So on an Excel, I can go from 100 to 1,000, but that does not justify that 1,000 can be achieved. You have to show how the market is performing, whether you're in a domestic market and then you're looking at international opportunities, or you're going to gain market share domestically as well. I think independently, you have to be able to tell a story as to what the opportunity is and be able to demonstrate by independent research reports that the story is actually, which is, available for you to grab and capture. And the last is, obviously, if you have companies who are your competitors who have already gone public, I think the valuation that they command in the market will act as the baseline when you enter into that same ecosystem. So I think these are the 5 pillars around which the entire valuation story is built. It's not just one. So what happens is, when you start off a conversation, you would predominantly look at financial numbers and kind of create a band. But when all of these other pillars play out, and that will only play out as you execute the assignment, that's when the final valuation assessment will get ready for discussions with investors. And again, you have to think from a perspective of that, it's not the banker who's going to put the money on the table, it's the investors. So we always say that valuation should be equitable valuation. It should be fair valuation, making sure that the investors get the entry point into the company at a valuation that can help them make money. Please understand, I think promoters should understand that, you're diluting 25%, at most 30%. You continue to hold 70%. You cannot drive the valuation for your company in the stock markets. It's the 30% holders that will drive the value, right? So make sure you leave enough on the table for investors.
Thank you very much, Ivor. I think many people will get a perspective on the reality check on the valuation. It is not like hearing from A that this is valuation looks good and B say I will get you more valuation. It is not a bargain. It is the real equitable valuation and fair valuation which plays an important role. With this, I want to move to Mr. Ranganathan again. Sir, you have mentioned the high corporate governance, the setting of the right board, etc. After doing this also, but what is the also most quintessential from your regulatory approval perspective, cost of compliance perspective, which are on the main board vis-a-vis the SME IPO stock exchange related corporate compliance and cost of these compliances? And once the organization set on these SME IPOs, with your experience and with the recent tightening up on the regulation, how one should consider in mind for moving to the main board, the transition, because everyone who wants to the step one would like to go to the main board. So what are the key things which they should keep in mind with this things in mind, basically?
Yeah, Nitin. So I'll just extend what Ivor said. He said, promoter should not come to the merchant banker and start the conversation with what is the valuation that you are going to get. I think that's the first thing. So similarly, when the promoters come, when the promoters think of a board, first of all, you should not think of a cost. You should not think a board composition, paying a normal sitting fees and other thing to be a cost. First and foremost is, the board is not going to micromanage the things, friends. They are going to add value. They are going to add value. I mean, that's what the example which you quoted of a good board. All SMEs should actually aim for to have some very good professionals on the board. India is plenty. You have plenty of professionals to support the SMEs of the world. So that's the reason I think the board. Why I'm emphasizing on that is ultimately it is the board which the reputation of the company lies in the board composition. So and that's the reason I reiterate my point that please, it's not a cost. It's going to add value. Don't look at only the numbers on the P&Ls, on the income side of the P&L, and don't look at the expenditure towards this cost of compliance. There is nothing called cost of compliance. Look at the cost of non-compliance is what I would put, Nitin. So I think that is where the things, most of the promoters, don't come and talk to me at the first instance about valuation. Don't come and talk to me. However, you should also say, be a good, think of a good board. Think of a good board is what you should also suggest. Secondly, Nitin, just a small couple of things which I just wanted to understand, which I have seen with the regulators, returning the documents or rejecting the documents. Some of the things are, avoid the circular transactions before you come for the IPO, please. I think a couple of years, 2-3 years before you aim for an IPO, avoid the circular transactions. And that's why the latest amendment very clearly talks about that the money should not be used for repaying the promoters or the promoters group's loan that you have borrowed. I think it's a very good amendment that it has brought. Secondly, Archana also mentioned about the objects. As I said at the beginning, the business model, the objects for which you are going to raise money. The third thing is, don't play with your financial statements, friends. Don't play with that. I think you're going to the public, show them the good picture, show them the realistic picture. Yes, the public is there to support, the investors are there to support in the long run. And you should also think of migrating to the main board gradually. I think the gap of 3 years, you should feel that why should a gap of 3 years be there? I should be in a position to go to the main board at 1 year. That should be the thought process of any SME. If you're talking about a good SME, that should be the thought process. Thirdly, what I found is inaccurate or incomplete disclosures. Now that's where I think all the merchant bankers and the the law firms and other things, whoever the team which is involved in the SME should really guide. I would feel that we should guide more to the people especially on the inaccurate disclosures. And in fact, in some of the cases where I have seen is they even forgot, or they have not even disclosed the material litigations. That is something, and don't inflate your figures just before you hit the market. I think everybody knows, everybody, even the retail investors, they are able to understand what is what, in terms of the financial things. And no more, you can use the jargons and get away with it. So please be mindful of, I would put these 3-4 things. And also, one very vague statement they make is the working capital requirements, the purpose for which working capital requirements. Be very clear. There are a lot of bankers to fund your working capital rather than coming to and raising money. It is for actually capital expansion. It's for capacity building, and that's the reason you go to the market and raise funds. I think some of the things which, if you keep in mind, if you have this thought process, if you draw down the line, you draw a blueprint very clearly at the at the initial inception stage before you launch the and of course there are a lot of people to help you. And I would feel these are some of the points. So don't look at the cost. I would reiterate, don't look at the cost. When you calculate the percentage of cost vis-a-vis your total cost, I think it will be a minuscule. It will be a minuscule. Don't look at that. Don't look at the effect of non-compliance is what I would really pen down, Nitin.
Got it, sir. Thank you very much. So the statement I want to sum up what you said is, if you feel compliance is a cost, try non-compliance. With this, I'm moving to Archana. We have a question coming from the audience here. That what are the recent changes from the SEBI which are going to affect and impact in terms of the launching of the SME IPO? Would you like to throw some light on it, Archana?
Sure. So this event that we are doing is a come at the right time, because just recently SEBI has kind of rocked the boat a little bit. They have some of the things that the exchanges were enforcing earlier, but without the actual words being written in the law, that they have now brought into the picture. So some of the technical stuff I'm going to leave out, but some key things that they have changed is one is that SEBI has brought in the criteria of 1 CR of EBITDA in the last 2 out of 3 years for SME IPO. I think that's a thing that was something that everybody was confused about. Am I eligible? What is the timeline, etc. And second, they have said unequivocally that you have to be in existence for at least 1 year if you have converted as a partnership. So from a track record perspective also, they have put a kind of a threshold or a benchmark, so that only after that you can think of IPO, because otherwise it was not clear. Some cases they were getting approvals. They were incorporated as a partnership which was converted into a company. So this is the second one. Third is exit to your existing shareholders. I think that has been capped to a maximum of 20%. Now we have to understand that this is not like the main board. So here, if your shareholders are exiting at the time of the IPO, it may not be a very good sounding horn to the other investors who are coming on board. So there is a 20% issue size, a capping on the 20% issue size. Similarly, you will have the balance 50% can only exit, can only maximum 50% you can give up of your securities. So non-promoter shareholders who are exiting will have to follow this. There are other changes in relation to lock-in, etc. have also come in, but those are slightly technical. But from an objects perspective, which we discussed and which I'm sure is the question, earlier there was no fixed cap on this, but now the general corporate purpose, if your object is a general corporate purpose, not more than 15% of the IPO proceeds can be used for that. Now this is a big thing, because a lot of SME IPOs, like sir said, like Mr. Ranganathan said, they go for working capital or other such objects. So now there is a capping on that also at 15% or 10 CR. And of course, the biggest change is that do not take money from the public and pay off promoter group company loans. That is simply not acceptable. That is what a big no-no. The one big change which probably Sir and Ivor can come in from an industry perspective is that you have to now disclose your DRHP 21 days prior to the actual filing. Now, how this is going to play out and what is going to happen, maybe Sir or Ivor can throw light on that.
Sure, Archana. Thank you for giving some of the snapshots of the recent changes. In this morning, I've also collected some data for the audience that from Jan to March, around 56 DRHPs have already been filed in BSE, and around 38 DRHP have already been filed in NSE. I think the whole statement which was made sometime back in a conference by a senior person from the regulatory side was, in next 2 years, be ready for the 1,000 IPOs. I think the statistics and the way things are going are very, very optimistic. With these numbers in mind, I have a question for Ivor. Basically, many people have myth around the whole timelines issues. People say 12 months to 6 months to 2 years and everything. Everybody has a different answers. So what is the entire process or the timelines? Would you like to break down in terms of each stages and the timelines for running the entire SME IPO?
Yeah, and that's a very pertinent question, because you need the entire ecosystem. While you have the intermediaries like the bankers and the councils, you need a lot of time and effort from the company as well to support the process, right? So broadly, I would say, if I break it up, so when you sign up to say, yes, I want to take my company public, you get on the intermediaries together. From the time you start the process, it would take anywhere between 3 to 4 months to get the document written up. At the lower end, 3 months. At the outer end, maybe 4, even 5 months, depending upon the readiness of the company and how strong a team and a process and an internal control system you would have to engage the bankers and the councils real time in terms of sharing and exchanging of information. Right. I think you have to also keep in mind that this also comes with making sure that you bring on independent directors, you have your complete clarity on where you're going to spend the money, and you're also getting all the underlying documentations ready from that standpoint. So once the document is ready, say for example, it takes 3 months to get the document ready, you file it with the regulator. The regulator today takes at least a couple of months before they give you an approval. It could even extend longer, right? So the bare minimum is 2 months. We're looking at 3 + 2, 5 months, and then post that, you're looking at, if at all, so that your accounts cannot be older than 6 months. So if at all, by the time you get the approval, if your accounts have become stale, then you have to refresh. Now that itself will take another 45 a month to 45 days or even longer. And then you get your red hearing prospectus ready. And I think then you kind of look at timings for launch of the issue. So in our experience, I think bare minimum of 6 months. I don't think a transaction can ever be done before 6 months from the time you start. The max it should go is 9 months. So I think anywhere between 6 to 9 months, you should effectively be able to execute an SME IPO transaction. So that would be, my advice to the audience in terms of the timelines they should aim for.
Just
Sure.
wanted
Thank you
to
so
add,
much. Yes, please, Mr.
just
Ranganathan.
wanted to add a couple of things to the latest amendments, which I think all the SMEs should be.
Yes, I was coming on to that. So when you are addressing the latest amendments and the super technical ones, please do also throw a light on the market making. Said SEBI made compulsory the market making for a stipulated time period. So that will be very much of an interest to the audience.
Yeah, I think two main things which I think all the SMEs should take care of is one, she talked about the GCP getting reduced to 15% is one. Second thing, also be mindful of the fact that when the issue size is more than 50 crores, you need to have a monitoring agency. It's not 100 crores as for the main board, but it's for 50 crores. So that comes into a picture. Second thing is even the minimum investment size has gone to the application size has gone to 2 lakhs. One very good thing, Nitin and everyone, what I felt in the amendment is any further issue by SMEs, any further issues, they need not go to the main board and then migrate to the main board and do this. Provided the only confirmation that they should give is if they have to follow the listing guidelines, listing regulations as applicable to the main board. I think that's a very welcome sign which I felt when I read the entire amendments. So friends, SME friends, I think that is one thing which you should take care of it. As far as market making, yes, initially everybody thought that you need some market maker to create a demand and thing. Yes, no doubt it has worked, but whether it has really worked in the real sense for which it is made, slightly the answers could be completely different, because in some cases there were no trading at all, but in some cases it has gone overboard. I think we should take advantage of this person who is acting as a market maker. I think, the things will go on its own, provided there is no interference from the management side. I feel they are also doing their fantastic job, but at the same time, don't pressurize them is what I would feel. I can add to this, but don't pressurize them, with whatever way you want the market to go. Leave it. I mean, that's a beauty of equity shares, that's a beauty of it. Second, last one, I know, Nitin, I would also say, please, friends, don't think that this is a collective investment scheme going and taking money. This is an equity. Respect that instrument. The only value creating instrument in the capital market, right? So when you respect that and, as you draw the blueprint 2-3 years well in advance, I think the things will be very smooth, and I think regulator also will be happy. Everybody would be happy at the end of the day, Nitin.
I just want to make one comment to what Mr. Ranganathan said, right? Look, I think when you look at social media and you see how retail investors engage, it seems like IPO is an instrument that gives you returns phenomenally other than any other instrument on this planet. And I think that myth needs to be busted. Honestly, I think, yes, investors should make money, but it should be a reasonable amount of money and it should not be like a day one return, right? There's no instrument on this planet that gives you a day one return. I think there should be decent amount of capital going in to support SMEs, and it should be at least medium term capital. And even retail investors should have some patience to let the company consume capital and deliver returns. I think expecting SME companies to give you a 20, 30, 40% return on the day of listing is completely absurd. And therefore, I think the role of the market maker and every other intermediary needs to be revisited in light of what the expectations are from investors. So that would be my short and sweet comment on that topic.
Thank you so much. I will have one follow-on question to this when you have discussed about it. Uh, Always there is a doubt in the mind of the promoters whether I go for a stock exchange A or whether I go for a stock exchange B, and what is the criteria to select for it. And now with this heavy and healthy competition, I would say that with the road shows being put up by each of these stock exchanges, what's your personal take with your experience and how one should really choose this?
So I would not put my personal take in this public forum. I think what we generally do is, help the promoters make the decision. You have one exchange, which is the oldest exchange today. You have one exchange, which is the largest exchange. Each one of them bring their own strengths to the table. I think one of the key criteria today when deciding the exchange is also in terms of how soon a exchange can facilitate an approval process. So if an exchange is saddled with a lot of transactions, then probably you want to think very logically of submitting your application to an exchange which has a slightly lower throughput of documents for review. And in that case, it would kind of expedite the process. So I think some of those pointers would play a more influential role in selecting an exchange rather than just going specifically in terms of what the history has been and what the kind of numbers play out today.
Thanks,
I
Ivor.
kept it
I
very
think
diplomatic, Nitin. I can't stick my neck out on this one. Sorry.
no, I completely agree with you, and people will reach offline if they feel some more deep diving is required for sure. With this, I move to Archana as time is pressing, and then last question to Mr. Ranganathan. So, Archana, we have talked about the due diligence, we have talked about the DRHP filing. In between, there is a leg or instrument I will call a pre-investor documentation. What are your views from the company perspective vis-a-vis the pre-investors perspective, and how one should take care of those documentation?
Sure, that's an interesting question, Nitin. A lot of companies do get pre-IPO investment. They have mandatory requirements to increase their capital also, and they have probably friends, family, employees, people who are consultants who want to be part of the whole IPO journey. So our advice to them is always this: please do look at the regulations which do not allow you to have convertible instruments or have some fixed pricing on conversion, etc. And also look at the documentation, because every single documentation you enter into at that pre-IPO stage will need to be disclosed in the DRHP. The good part about the capital raised post DRHP is that it is it's a regulated kind of capital because the law already provides for it. But just before filing DRHP, when you are raising capital, remember that disclosures will follow. So the documentation has to be very detailed and meticulous for that.
Understood. Thank you so much, Archana, because this leg is very last minute leg and people struggle to figure it out how to fix this when they are in the journey of filing the DRHP. So, Mr. Ranganathan, one very pertinent question which always comes in every promoter's mind when they hit the road to meet the advisors, when they meet their merchant bankers, legal advisors, their chartered accountants, company secretaries. So basically, they are all running as a family businesses, most of the SME IPOs. So this journey and paradigm shift of being a business, family business owner to a institutionalization approach, what are the key takeaways for the promoters and how do they need to shift the gear and when do they need to shift the gear from a family business to a institutional business?
I think it should start that the time that you think that you need to go public is the day that you should think that I should be surrounded by true professionals. I think that's the first step that they should start. I think start employing. Again, it's not a cost, friends. It's again an investment. I mean, investing in professionals is an investment rather than a cost. So start at the beginning itself to have some very good CFOs and the company secretaries and the legal heads, legal counsels and everything, start to build an internal, very good internal team. When we talk about a board for the promoters to, build a very strong professional team, within the organization is the first thing that I would suggest. And secondly, don't call for bids from 10 professionals for the same kind of a work. Professionals are professionals. I think you should have faith in the professional fraternity, saying that yes, I'm giving it to this XYZ. I think he or she or this firm will be able to do a very good job. I think, see, it's a revenue for them. Understand, friends? It's a revenue for them, right? And every professional, so my request is, don't go and do a road show for professional advisors or the merchant bankers. I think there are a lot of very good merchant bankers and the professionals who will come and handhold you. Let me put that word, handhold you. It is not that something which they're going to don't use the word examining, investigation, nothing, friends. It's hand-holding the promoters and the team around that to come to the market and help them in their journey for raising the IPO. I think if you have faith, you should have faith. If you have faith, I think the journey will be very, very smooth, is what I can sum up, Nitin. That's the way I would put it in very simple terms.
Thank you very much, sir. I think you have given a lot of enlightening to the promoters and the professional advisors who are part of this webinar today. All three of you, I would request one by one to give any one key takeaway for the professional and for the promoter. I can start with Ivor and complete with Mr. Ranganathan. So one key takeaway for the promoter and one key takeaway for the professional advisor.
Promoter is, ask the question, explore, because this is an instrument that will help you raise money. It may work for you, it may not work for you, but there is no fees charged for asking the question. So it's pro bono. We do that pro bono. So feel free to ask the question. The second one you said for the advisors.
That's correct.
For the advisors, I think, just be, I think the advisors need to be honest in making sure that the company makes the changes that are required to present a very strong case to capital market stakeholders and not cut corners in the guise of doing the transaction quickly. I think the promoters will look to advisors for guidance and for support, and they have to be true to their profession and call a spade, and accordingly help the company and the promoters navigate that journey with all honesty.
Thank you so much, Ivor. Over to you, Archana.
I think the key takeaway is that it's going to take time. People are going to ask you questions. So promoters have to believe that whatever preparation we are doing today, whatever work we are doing today is going to protect us tomorrow. The legal advisor or the merchant banker you choose should be someone who will never let you down in front of the regulator. Somebody who will question you, who will fight with you, like Ivor said, we are true professional. So it is, I think, a double-edged thing for promoters and professional advisors to tell the correct story, to be honest, and to know that this is going to take time. There are a lot of regulatory things that need to be tied up at the back end.
Thank you so much, Archana. Yes, Mr. Ranganathan, how would you like to conclude with your experience?
So the promoters, I would say that timing is very important. define the business model so that a layman can understand. I think that's the first thing. I think whenever you are able to explain to a layman, that means your concept is clear. So, so the business model should be explained in a very consider this a beautiful instrument and give a very positive picture to the the prospective investors so that they stay invested in your company, and also the institutional investors come to you. I think that should be the aim. As far as the professionals, I would reiterate in a simple word: handhold the company in their journey. Tell them and find and give them some good solutions. I think as regulatory amendments change every day, be update, keep abreast of the changes that happens. And if the company is saddled with some kind of a technical problem, I think there are different ways and means in which we can help. Tell them, advise them, tell them that it's going to take time, give them a realistic time frame, and I think be with them so that all the promoters in the SME, they come to the market to very quickly have a smooth journey, and also think of going to the main board at the earliest. And last, Nitin, have a good board, have a good team of professionals around you. That's all. Thank you.
Thank you very much, sir, for your candid advice. And thank you, Archana and Ivor, for joining this panel. I would like to thank all of you on behalf of Agam Law Associate for joining this session. And I would like to hand it over to Akshat.
Thank you very much for your detailed expertise and sharing your knowledge with our participant. And I see that you already answer all the questions in the Q&A box and the chat box to all the attendees. So at the end, we don't have any much question with us. And I request to all the participants, if you have any query related to the theme, you can share with us. We can send all your queries to our panelists, and they will answer you through email. And we also share the Agama Law Advisors profile with you, in which you get the update how they can serve you and what are the services they are offer you. So you can directly contact with your team also. If you have any issue, facing any challenge in contact, you can reach out to us. We can connect you with them. And thank you very much for today's session. Thank you very much to all our speakers. And we will update you soon about our next session. And we are opening much more session with the Agma Law on the different topics which are fruitful for the SMEs, MSMEs, and startups especially.
Thank you.
Thank you, everyone.
Thank
you so much.
Thanks, Ivor, Nitin, and Archana. And thanks, Akshat.
Thank you.
Thank you,
very much.
Akshat. Thanks, Archana, Ranganathan.